Good evening and welcome to tonight's AHDB webinar. My name is Richard Meredith. I am a Knowledge Exchange Manager at AHDB on the cereals and oilseeds sector. I'll be chairing tonight's webinar for you. Before we get stuck into the detail, I'm just going to run you through the housekeeping. We're all muted, so don't worry, we can't hear you. There is a question box on the right-hand side of your screen. If you have any questions, please feel free to, or comments, please feel free to add them in there. We're aiming to conclude around 8 o'clock. There will be a formal question period at the end, but we do encourage that you ask any questions or challenges or points that you want to raise as we go through. There's quite a few of you booked in tonight, so we'll try and manage those as we go through. If you are Basis, Noroso or Dairy Pro registered, then please add your registration number, date of birth and postcode in the questions section, or alternatively to myself who emailed the invite to you. If there's anything you want to revisit after the webinar, we will be recording it, and if you registered to watch, then you'll be automatically sent that link. Also, along with that will be a survey where we invite you to send back your opinions and thoughts on future webinars, so please don't hold back. So, to set the scene tonight, I'm sat in the offices at AHDB next to our speakers, Martin Williams and Philip Dolbear. Philip is a colleague of mine in the cereals oilseeds sector, and Martin I've been working with for the past year now as a monitor farmer. He's the Hereford monitor farmer within the West region. I've asked before we kind of dig into the detail and the content of tonight that Philip and Martin just kind of lightly introduce themselves and give you a bit of a history to why they're here tonight and what qualifies them for that. Philip, I'll just hand over to you for a moment.
Thanks, Richard. Good evening, everybody, and glad to be doing this. Looking forward to the next hour or so. Yes, just to give you a bit of background to myself, started off at Reading and then moved through a fairly short lecturing career at Hartbury College on to join ADAS, where I spent 7 years, increasingly over that period, specialising in farm business management and accounts. That led me to Midland Bank as it was then, but now HSBC, where I had 20 years of agricultural banking mainly in the Southwest team, lending money to farmers and trying to get it back again. And then I joined HGCA as was now AHDB some 5 years ago now, as Richard has said, in the knowledge exchange team, still in the Southwest, looking after the cereals and oilseeds sector in that area. So now I'll hand over to Martin, and Martin will just give a bit of background about himself.
Hello, everybody. My name is Martin Williams. My CV is half of Philip's, unfortunately. I'm a farmer in Herefordshire. We're sitting now, as Richard said, in a deserted office at Stoneleigh. I am the token farmer, sitting listening to the ticking clock and the faint sound of a vacuum cleaner. I'm a cereal farmer at home with some grassland and a bit of contracting. We do some commercial lets, and we've got a little bit of solar. I've got a couple of members of staff, and we have a few more in the summer. But I'm the token farmer. I'm definitely not an accountant, but I can lift heavy weights. When I was younger, I grew up driving a tractor, as I still enjoy. Unfortunately, as I've got older, I seem to spend more and more time sat in the office, and these things that we're going to discuss tonight have become more and more important to me. I'm looking currently at the structure of my business, and I'm looking forward to listening to see what Philip can teach me later on. So that's me. And Philip's going to hold my hand all the way through, as he is already. He's a little sweaty palmed, but I'm sure we'll get over it.
It's usually the farmer that's got the sweaty palms when the bank manager's about, Martin.
Exactly. Yeah, exactly.
There's nothing to worry about, gents. Right. Tonight's webinar is really kind of looking at focusing on how you can prepare for a visit from your bank manager, how you can make yourself and your business a attractive proposition for them to lend money to. We thought we'd set the scene tonight by just asking Martin kind of what kind of relationship do you look to have with your bank manager, Martin? How do you look to develop that?
I view my bank manager as a friend. If he's not my friend, he's going to be my enemy, and if he's my enemy, then we're not going to get on much. When I started farming, borrowing was almost a dirty word, a little bit like TB, and now everybody's doing it. So my relationship with the bank manager is an honest one, a friendly relationship, and something that we have to do to work together. There are not many farms anymore that can work without a bank. There are lots of things we can work without, but a bank isn't one of them. And therefore, for me, it's quite important that we speak to each other and keep in touch. That's what I'm looking for.
And Philip, tonight we've asked you to wear your bank manager's hat from your previous experience at HSBC. When stepping onto farms and meeting farmers, what kind of relationship were you looking to build with them?
Well, absolutely, as Martin said, it's very much we rather than them and us. The key is a partnership. Both got to exist, both got to stay in business. Martin needs a banker, the banker needs a customer, and both have got to find a way ahead, a mutual way ahead to coexist for each other's benefit. So, Martin, perhaps you'd just like to sort of talk through some of the thoughts that you got in terms of what you're looking for out of farming, because I think that's a key place to start, is for the farmer to know actually what they want.
Exactly. Well, all farmers are different. We've all got different wants out of our farm. Some people want just to live there. Some people want to expand. I personally have gone through my 20s and 30s where I thought I was invincible, in through my 40s, and now I'm into my 50s, and my outlook on life is changing. My outlook on farming is changing. Therefore, I'm looking for a lifestyle. I'm thinking about succession, which was also dealt with Heather Wildman's previous webinar. And it's very important that I know where I'm going when I get to my 50s now, because in my 30s I felt I was going to live forever. From a farming point of view, are we looking to expand or are we looking to survive? And if we're looking for something different to do, we'd be looking for funding for which to explore that avenue. Nothing comes at the moment without a cost. Tractors used to cost tens of thousands, they now cost hundreds. Cattle crushers used to cost hundreds and now they cost thousands. So times are changing. What I want out of my farm is to live in a beautiful part of the world, to enjoy life, not feeling too stressed, and to have some direction in where I'm going. So that's what I'm looking for.
Yeah, that's a really good list, Martin. And I think, as a bank manager, it's really good when you sit down in front of somebody and they really do know where they want to go. I suppose the only thing I'd add on to your list, and you sort of alluded to it really, but to use a cliche, cash is king. And what you've really got to get to grips with is that realize what amount of money you need to generate from your business to cover a number of items. And I've listed these out, but these have all got to be paid for. So the surplus after you've done your sort of variable costs and your normal rent, your normal fixed costs, but the rent's got to be paid for, the bank's got to be satisfied. As you said, you've got to replace machinery. How much do you need for that every year? You want to keep moving forward, reinvesting into the business, growing the business, achieving the objectives you talked about, and you've got to live. There's that boat, there's the fast car, and dare I say it, the taxman might have a say as well at the end of the day.
Unfortunately, that's the case, and it's always a bank manager's job to spoil the party, isn't it? The farmer's objectives might be slightly different to the bank manager's, but they've both got to be happy. So come on, Philip, show me what we've got to do.
Well, I don't think there's anything wrong with them being different objectives, but you've both got to meet each other's objectives. Really, you've outlined what you want, and you're able to put a figure behind that. From a banker's point of view, when I'm coming to see you and looking at your business, there's sort of three key questions really that I'm asking myself. The first one is I want to know how strong or robust your business is, and we'll talk a little bit about what that means in a minute. Secondly, if I'm going to lend you money, how easily is that business going to be able to repay the debt? How much can it take knocks? How long is it going to take? And ultimately, the last question there, is there a risk that I might not get my money back at all? Because that at the end of the day, the banker makes money from lending money, getting it back with a margin. The margin's his bonus. Where he falls down and comes unstuck as if he doesn't get the money back at all. So that is a key question at the end.
It comes to a bit of a story as well, doesn't it? Because businesses are all different, farmers are all different, and therefore their willingness to repay or their aim to repay debt might be slightly different as their circumstances change. In my position, I have no succession, I have no children, and unless I'm going to find one under the hedge that the stork left somewhere, I would imagine that my exit strategy would be slightly different to someone with children who wants to leave their farm either debt-free or rent-free for the next generation, possibly, or someone that might want to pass that debt on to the next generation with a hungry youth.
Yes, and that's where it comes back to the partnership between the two of you, because as you're saying, you've got slightly different objectives to perhaps the bank manager, because the bank manager might want to see that debt repaid a bit more quicker than you might. You might prefer to enjoy the cash flow rather than repay the bank. So you've got to help the bank manager round his problem that he might be not going to get his money back as quickly as he wants. And we'll talk through sort of the process and how you can build up your story, build up your defense, if you like, to make the bank manager more comfortable meeting your strategy as well as perhaps in a longer term meeting his strategy. From a lending point of view, the bank manager makes his decision after the first two of those points. Have you got a strong business, and is it going to be able to repay the debt? The last question really affects the risk of getting your money back. I mean, in truth, if the bank manager doesn't think he's going to get his money back, he's not going to lend it to you in the first place. The ease in which he might not get his money back starts to impact on the cost of that borrowing. It's a risk and reward story. So we talked about you getting your case together and preparing yourself to meet the bank manager's requirements. The first thing really is that first statement, to be prepared, and it's all about preparation. We'll talk a little bit about figures in a minute, or quite a lot about figures actually, but just to mention a couple of other items there. It's a bit light-hearted, but sometimes a story, a book cover does tell a story, and first images can count. And make sure the yard looks respectable. Shut the dog away that's going to bite the bank manager. Sweep the yard where he's going to get out of his car in his shiny shoes. When he comes into the office, does it look like an office? Is it a sort of does it look like a well-run business? Does it give the bank manager confidence that he's lending to somebody who looks pretty organised in the first instance? Anyway, the next point there about family and others is make sure you've got the key members that are important to your business present at the meeting. If your wife or partner or husband is a key part of the success of that business, it's really important that he's there as well for the bank manager to meet him or her and see the whites of their eyes and realise how the business ticks and how the team works together. And also perhaps the accountant, perhaps the farm advisor. If they're all critical to the business, no harm at all in them being there. I've been to meetings before where perhaps the herdsman was the key person because it was all about dairy performance. So it was important for the bank manager to see what the herdsperson was like as a character and as an individual to carry out the plan.
I think it's important, yes, that the family are there if they're involved in the business or even slightly close to it, so they know what's going on, because it could come a hard pill to swallow if you haven't been involved in that, and eventually something happens to mum or dad, whoever's running the show, and then you've got to come into it cold. So I think it's quite important for family members to be involved in it. And if you want to let the dog go as the bank manager's leaving the office, if he hasn't given you the answer you like, then all well and good. No, I agree with that.
Yeah, and the last point there is we've sort of alluded to it, but be prepared for the meeting in terms of what you want to discuss, what you want the outcome to the meeting to be. Your bank manager will have his agenda. No harm in at the beginning of the meeting you stating yours, him stating his, to make sure that you're both singing from the same hymn sheet and you're both aiming for the same outcome to the meeting. So sort of looping around to the first point of those figures, the first point there, the figures. There's two key documents really to have ready and be prepared for your meeting. One is your profit and loss account, and the second one is the farm's balance sheet. And we'll deal with the balance sheet first. Martin, your accounts will have a balance sheet, but I suspect, like many, the balance sheets and the accounts might not be the truest reflection of what the real situation is.
No, I think you're quite right. The balance sheet and the accounts are for accounting purposes, but in real life, real life doesn't happen like that, does it? So yeah, where does it all come from?
Yeah, so it's really important that you show the bank manager what the real picture is. It's called various things with various banks and organisations, but I'll call it a statement of assets and liabilities, the farmer's statement. This is one I've used in the past, and as I say, there are variations of a theme here. But what this basically does is give a realistic, a current market valuation of your business. Down the left-hand side, all the liabilities of the business, how much you owe the taxman, the HP on the machinery, the creditors, the bank loans, family loans as well, because that might be important to the business, and then bank overdrafts and loans as well. So the total liabilities of the business, and then value the total assets of the business, current assets, livestock, crops in store, grown crops, your current account, on-demand overdraft balance, whether it's positive, if it was negative, it would be over here, obviously. Debtors, money owed to the business, and then looking at the fixed assets of the business. And this is a snapshot today, or on the day of the meeting, or just before, whenever, of what your business is worth. And effectively, it's adding up every penny you're worth, taking off every penny that you owe, and the net capital, the net worth, the surplus is what, if you decided to walk away from it on today's valuation, you would take away.
And this differs from your profit and loss on your balance sheet. With your balance sheet, you might have your cattle done on a herd basis, which would be devalued for tax purposes anyway at 60%.
Land would be valued differently.
Land would be valued differently.
Machinery would be depreciated.
Yeah,
etc.
Day-to-day sale value today.
And it's really important, and we'll talk about trends quite a bit over the next 30 minutes or so, but what's really good, if you can start building a picture of these year on year, fill them up at the same time roughly each year, use the same sort of protocols as to what you include in certain categories. So you build up a picture of how the business's balance sheet, hopefully its surplus is increasing as it's building capital over the years. There are one or two sort of things you need to watch out, and people fill them in slightly different ways. So some people might include in debtors money owed to them from basic payment scheme. You could argue that, well, until it comes through the letterbox, you don't know whether you've cross-complied and whether you're going to get that money. I'm not too worried about that, as long as you do the same thing each year and you communicate to your bank manager what's in there, so you know what's in there, what's not. The other things you just got to watch out are, if you're perhaps a tenanted farmer, one year the rent check might have gone through the overdraft, the other year it might not have done. So make sure you picked up whether rent's due as a creditor or whether it's in the overdraft, but not put it in both. So those are just two small examples. In terms of land values, tractor values, you're only kidding yourself. This isn't for the pub. This is for you, for a realistic picture of your business. So be not silly optimistic or silly pessimistic, but just what's a fair market price to give you that picture to your bank manager of the business.
I suppose this could almost be called the farmer's health and harmony statement, if we're being very trendy at the moment, because keep you up to date with what you're doing. And this is something that I should do more of, but I don't. So I'll hold my hand up.
Your bank manager will have these sheets. You can ask them for them in advance. Really good, and it sort of ticks a box. And if you can have the figures at least prepared or ready for him to fill in, or even have filled in a form in advance for him or her as the bank manager, because it saves them a lot of time, and it gives them more time to just ask questions and understand it, rather than worrying about whether they've trawled through your mind and your accounts box to make sure they've got all the figures. So from this statement of assets and liabilities, we can look at some ratios which will start coming on to giving the bank manager a picture of how robust. I talked about how strong or robust your business are. There's four ratios we're going to look at, which I used to look at as a banker, and all the other banks will be the same. The first one is the first two rather, as looking at the strength of the business. How highly geared is it? The first one, just looking at the gearing of the the liabilities on which you're paying interest, so things like HP finance, overdrafts and loans, and what that is as a percentage of the net capital, the net worth figure that we worked out earlier. So how much of your net worth are you paying interest on? Secondly, the total gearing. Total gearing is adding up all the liabilities down the left-hand side of that farmer's statement. So it's pulling in, the money you're owing to the taxman, your creditors, your family loans, the whole bang shooting match. And again, what proportion of your net worth is that figure? And I put there guides which we were looking for these percentages to come under, and where if they went over, we started getting a bit twitchy. So those are the first two ratios. The third and fourth one is looking at the serviceability of your debt. So interest cover, looking at getting your accounts, looking at the profit figure, the profit before finance, and seeing how many times that profit you're generating will be covering the interest that the business has got to pay. And lastly, sort of how flush or how liquid is the business, just looking at the readily what's the word I'm looking for? Cashable assets, saleable assets. So your livestock, your crops, how much they'll cover the liabilities that you've got to cover, like your overdraft, the next 12 months of HP maintenance, the next 12 months worth of loan. So the bank manager would know that certainly in the short term, the business is generating or could generate cash to cover its short-term liabilities.
For me, this is quite a complex slide because there's 4 different items on there with 4 different multipliers. So hopefully Philip's going to show us through these a bit.
Let's work through a few examples. So the first one, this is again, remember, looking at how robust the business is, how much of the net worth, what percentage of the net worth the farmer's paying interest on. So in this farmer statement example we looked at, the farmer didn't actually have an overdraft. He just got some HP debt on kit of 76,000, had a loan of 300,000, and his net worth figure, the net capital of the business was just under 1.3 million. So the ratio here was a total of 376,000 of debt. What's that proportion of 1.299 million? So the ratio there is 29%. So this business's external gearing ratio is 29%, which, if you remember from the previous slide, we were looking for a figure under 75%. So that tells me as a bank manager that you're not too stretched in terms of what money you're borrowing and paying interest on against the overall the value of the business. Moving on to the next ratio was not just looking at the liabilities you're paying interest on, but all your liabilities. So the taxman, the creditors, which you won't be paying interest on those. Again, the HP, the family loans, which weren't in there before, that you might not be paying interest at all. So every single liability the business has got, which was the total of the whole of that left-hand column. So in this case, it came out at 680,000. Again, what's that as a percentage of the net worth of the business? And it's just over half, in this case 52%. Again, as a guide, that would be a strong business, because we would ultimately be prepared to see that business have a total gearing ratio of up to 150%, because obviously some of the liabilities aren't ones which are critical to the bank, so we're prepared to let it go higher than the 75 figure we were talking about earlier. You're following all this, Martin? I'm
following it with wide open eyes and studying your notes and my notes to see what you're talking about. So good. I am following it. Yeah, I'm with you. I'm with you all the way. When you have time to digest this and you've done it once, they really are 4 very simple figures you can work out. And I think if you really wanted to score marks with your bank manager, these are actually figures from that farmer's statement that you could work out in advance. And again, I talked about preparing ammunition, if you like, to defend your case about supporting your objectives. Here's an example. If this was your business, Martin, you could say, look, I'm really not very highly geared, so you've not got too much to worry about, because my total gearing is only 52%, and that would make him rock back in his seat when you work that out ahead of him or her. Exactly. I'll share with anybody that's still listening. If you're still listening to us, well done. But when I came in earlier on and we looked through these with Philip, it looked like a whole load of gobbledygook. So if you're feeling that it's gobbledygook, fan back through and see what you've looked at. It's actually very plain and simple once you get your head around it. I'm not saying that you haven't, but if you're like me, when you first saw it, it looked a bit complicated. But it's not too bad at all once you get your head around it.
A question on the floor was in regards to the HP figure that you're showing here and the total gearing. Is this the total left of the HP?
Yes, HP debt outstanding. Yes, for the business.
Thank you. Does the net worth value include growing crops?
Yes, it would normally by convention. Yes, and different people take different views of how to value growing crops. Most people tend to value them on the basis of what inputs have gone into the crop today. Right. Are you the same on that, Martin?
Yeah, I'd value mine on the day as to what's been put into it up to that day. Yeah.
Again, as long as, like I said before, as long as you do the same thing each year and you do it on the same basis, so you're comparing apples with apples, then that's fine.
Thank you.
It'll depend on your year end as to what you've done to a crop. It might be that your year end is 1st of January, you might not have done much, or it might be end of March, or it might be September. It depends when it is.
Yeah, it's a really good point, Martin, that you want to be doing this exercise broadly at the same time each year. Again, apples with apples.
Good time to do it.
Yeah. So moving on to the last couple of ratios, it gets a bit easier here, Martin. So the next one is the interest cover. So this is starting to give the bank manager a feel of how easily you're going to be able to pay the interest that he might lend you money on. So it's your profit figure, and again, this will come from the accounts. The profit before finance is how many times will that profit figure cover the interest that the business has got to service. So in our case study here, the business is generating a profit of 138,000 before finance. The interest payment of that business, he's got debts, HP debt of 76,000 and loan debt of 300,000. So he's paying, we'll assume for this example, 5% interest. So he's paying interest on that total of 376,000. So that profit of 138,000 will cover that interest charge by 7.3 times. So again, preparing your ammunition, Martin, that's a good healthy profit cover of the interest charge to that business, because the guy, we would be looking for a figure of 2+, or we would have been. So to have a business that's generating profit that will keep the bank manager happy sevenfold on the interest payments in the next year is good news. Yeah. And once again, one swallow doesn't make a summer. If you can show what that trend's been, every year for the last 5 years, my business has covered its interest charges by X times on average. It's just giving the bank manager confidence, and that's what you're out to do. You're looking to make him or her feel relaxed about lending you money, lending your business the money.
And at 7.3%, you could keep 3 bank managers happy by the seams of it. So it's not too bad at all.
One's probably enough at a time.
Is the pre-tax profit in the interest cover, this ratio here, is that pre-tax profit? Sorry.
Yes. Yeah. So it'll be the figure taken out, literally the figure taken out of the accounts.
Thank you.
So moving on to the last of these ratio, the liquidity ratio. This is again looking at in a short term, how much can this business cover the liabilities it's got to find in the next 12 months. So the next 12 months, that what the business has got to find, it's got to pay the taxman, it's got to pay the next 12 months worth of HP payments, it's got to service the creditors. If it hasn't paid them in 12 months, they're going to be getting twitchy. And it's got to find the next 12 months of loan repayments. So in this case, on the right-hand side there, we can see that this business has got to find liabilities of 309,000. This ratio looks at whether these ratios can be covered by current liabilities can be covered by the current assets of the business. And by convention, the current assets are defined as the livestock, crops and store, growing crops, the purchase stocks, so the fertilizer in the barn and so on. And if there was money in the bank as opposed to an overdraft, as in this case, that's there to help cover help cover those liabilities. And lastly, the debtors. You hope as much as you've got to pay your creditors in the next 12 months, you hope your debtors will pay you in 12 months' time. Debtors, money owed to you, obviously. So we've got our two totals there. The liquidity ratio. I know you want to say something, Martin. Just
I'm waving my hand frantically, waving.
So the liquidity ratio is how many times those current assets will cover those liabilities. So in this case, we've got nearly 3 times cover of current assets to current liabilities.
Another little line on the current liabilities is living expenses, which isn't showing in there, but a simple household, simple farmhouse, simple lifestyle, you're looking at quite an expense in amongst that little lot, which also needs to be accounted for, doesn't it? Does that come into that list?
It doesn't come into that list by convention. I guess the assumption would be that if you've lived, if you've spent money and you hadn't made the money, it would be sitting on an overdraft, and your overdraft will be in that right-hand column. So it would show itself at some stage.
So you're not actually a liability living at home.
That's debatable.
Yeah.
So in this case, we've come up here with a liquidity ratio of 3.1 times. When you look back, you'll see that as a guy, in the bank, we were just looking for the current assets to cover the current liabilities on a one-to-one basis. So short term, the bank manager would be relaxed that on-demand liabilities could be met by readily saleable assets. So those are 4 ratios. Again, we rushed through them a bit because we've only got an hour tonight, but you can do that yourself, Martin. You really
realistically, what we've done tonight is nothing more than handy housekeeping, like making shopping notes. It's just a case of actually physically doing it. It's easy to not bother to make a list and come home with half the shopping, and this is very similar, isn't it? It's just a reminder to make these little notes as you go through, and it's not relatively that hard. It's not hard what we're doing. Even though I'm fault shy of it, it's not that difficult. Yeah.
Philip, if anybody at home was doing any of these ratios and you've given us some guide parameters that you think they should be part of, what if you're outside those guides, what advice would you give?
Well, I certainly wouldn't try and fudge the figures to make them fit what the bank manager wants to hear. That would be a bad start. At the end of the day, you've got to be able to explain why they might be outside the parameters that the bank manager is looking for, and give him confidence that you or your business can survive and have got other means of supporting the business if it's unstuck on one of those areas. So an example might be, if your business was highly geared because you in your own right didn't have enough assets compared to the relative liabilities you got, are there other ways that you can support your business with third-party security? Now that's a whole new ball game of discussion, but at the end of the day, it's a way of bringing some extra collateral into your business by somebody helping support your business. So it could be family relatives pledging assets. Again, lots of regulations you've got to go through in today's banking world to make sure they understand what they're getting into. But it's a way of adding support to your business if you were not quite meeting the requirements of the bank.
And if it was the bank asking for more security, would you, on a farmer's perspective, would you be reluctant or willing to give it?
If the bank was asking for, I mean, at the end of the day, just because good security. Sorry, at the end of the day, security isn't going to make a bad proposition good. So if the figures don't stack up, and we'll come on to that next, if the farming proposition doesn't add up, it doesn't matter whether you can give the crown jewels of security. The bank really shouldn't be lending you the money, because then the banks aren't in it for pawnbroking. The banks are in it as a business venture to lend money, get it back with an interest charge, with a arrangement fee. It's not the sort of normal high street lending British banking system just to pawnbroke.
That's fair enough. So going on from our liquidity ratio, you mentioning accounts trends.
So
I think that's
so we talked about the farming proposition, and this really is key, because at the end of the day, it's the farming, it's the business trading that's going to service the interest. It's going to generate the profit, the surplus capital to repay the debt. So I talked about trends. Build a very simple table of what your accounts have done over the last few years, so you can show your bank manager how the business has performed. So in this very simple example, again, you can just take these figures from the accounts, because although the net worth, the balance sheet figures might not be the true market position, they'll be the same protocol for how they're prepared year on year, so it will show the trend, which is the important thing. So in this case, the business at the end of 2013 started with net capital of 1.25 million. It made a profit of 100,000. The farmer drew 20,000 for his drawings, so that left net capital at the close of 2014 at 1.3 million, so balance sheet rising nicely. In 2015, same process, it rose again. Took a bit of a knock in 2016, profit of only 20,000. Farmers still drew 25,000, so the balance sheet's gone backwards in that 2000. Now, what's really good here is you as a farmer, Mr. Farmer, being able to not look blank when the bank manager say, what the blazes happened here, Martin? Being able to talk to him about it, what happened, why, what you've done about it.
Yeah, well, over the past 5-8 years, the harvest and the price of cattle and the price of forage, particularly this year, is going to impinge on those figures, isn't it? It's going to be quite a big sway either way.
Absolutely, there's bound to be, and that's where we sort of link the two documents, the balance sheet we just talked about, and the trading performance. We all know farming's a very volatile business. But how much can your business stand the volatility? Can you draw on your balance sheet to fund those difficult years, and come back again for more in following years?
Yes, it could almost mirror the weather patterns if you're a cereal farmer. I should think this trend.
Quite
and
easily.
And if you put the currency pattern on top of it as well, it'd probably help with that as well. It's quite a fluid thing, isn't it?
Yes.
Quite a fluid thing. Unless you're doing something different within your business, it's quite a fluid thing.
Yes.
Unfortunately, going forwards, it looks like we're going to have to do something a bit different in our business, because we've got external factors affecting us. So going forward, it might be a different graph again.
Yeah. Well, we'll talk about going forward in a minute. Just before we move on for this slide, you'll see I put in a depreciation line there. I think it's quite interesting for the bank manager to see, your profit figure of 100,000 there. That's after paying 30,000 interest, because that
depreciation.
Sorry, depreciation. Sorry. Sometimes you'll have spent that figure, sometimes you won't. So it will give the bank manager a bit of an understanding of what's going on within that profit figure.
There's always going to be an element of depreciation and HP borrowing, I would think, in most businesses, which is something you can't shy away from altogether. I wouldn't have thought, if you're an expanding business. If
you don't invest, you go backwards.
Exactly,
because it will all just crumble and rumble to nothing.
So where do those figures need to be relative to your output or relative to your turnover? Where would you see those as being a comfortable percentage?
Well, I think I'm not sure so much as percentage is what the business has been able to service, and whether you've been able to move the business forward, keep everything up together, and show it on the bottom line with that net worth figure at the bottom there, gradually creeping up over the years. You start to raise an interesting point about investment strategies. Maybe we'll come on to that in a minute. One interesting figure that you can prepare for your bank manager should be in your accounts, and if it's not, it is something called a funds flow statement, or a source and application of funds, or a funds flow statement. Different accountants call it different things. Any year when perhaps you've had a decent profit, but there's no cash flow, and it'd be useful to you and to your bank manager to know where the cash has gone in that year. and it's something you should really ask from your accountant in advance to be prepared as part of your accounts package every year. This is an example one, a lot of figures here. Again, probably something to come back to and just chew the fat over slowly, but I'll just talk through very briefly how it works. So in this case, the business made a profit of 77,000. Add back the depreciation figure of 27,000, so the business generated 104,000 pounds near as to spend, if you like, for the year. Generated that funding. It also, working down, sold some machinery, so that was, if you like, more cash in the pot to use in the year. So we've got a total here, a total source of funds, if you like, of 111,000. Where did all that go is the question that you might be asking, and maybe the bank manager might be asking. So where did that 111,000 go? You sold some machinery up here. You also bought some, so 15,000 was spent on machinery purchases. You repaid off some debt, HP loans, some bank loans, 19,000. We talked about your living expenses, Martin. You spent 38,000 pounds living. Keep your shirt on your back, food on your plate, holiday, so on and so forth. So
it was only a caravan, honestly.
Only a caravan. So in total, out of that 111,000, you spent on all these things here 93,000, leaving 18,000 pounds, if you like, cash surplus, for want of a better way of calling it. Where did that go? The next two blocks of figures show that went. Some of it was sucked up by a change in your debtor and creditor position, and also in how you valued the stock. And lastly, the rest of the cash manifest itself in a change in your overdraft facility. So your overdraft dropped from 26,000 down to nearly 13,000. So those two figures, your 17,000 funds generated here, disappeared partly through creditors and debtors. So you didn't actually see it. The main part of it did show in a better overdraft balance. It just paints a picture to the bank manager of what's happening in the business, where the money's going. You know, is it all on drawings, or is it repaying the bank, or is it a nice happy balance of everything? And that, again, just building up a story, building up a picture of how you're running your business, and to give the bank manager more confidence going forward of how it might operate in the future.
I've got a couple of questions from the floor here, Philip, before we move on, if that's all right. First question, you've mentioned considering an interest cover guide. Any thoughts or observations regarding the total debt repayment or profit cover guide?
In a word, instantly no. And I think we'll come on to talk about repayment strategies in a minute. But at the end of the day, we talked in one of the very early slides, you need to generate profit to cover a number of items. It was you've got to pay your rent if you're a tenant, you've got to live, you've got to pay your private drawings, you've got to pay the tax man, you've got to meet your bank requirements. You've got to know those figures. That's your guide, really, what profit you need to make. And if you've, let's just say for sake of argument, you've added up, you need to generate 50,000 a year to meet all those requirements. If your profit is not close to those figures, then major rethink required at one end or the other.
Another question before I let you carry on. Would you classify retired family members who still take money out of the business as a liability? What would the bank's view on those retirees be?
We talk about a partnership, and I think it's really important for the bank manager to understand the whole family picture. And we know farming's an intergenerational thing, and there might be 3 generations living out of a business, and if they are, that's fine, but they've got to understand the business has got to generate profit for 3 families to live out of. And if it can't, should it be the bank manager that just chucks money at the business to keep them in the lifestyle they're accustomed to? Answer is probably not. They've got to take responsibility for the fact that they want to live out of the business and work out ways with the bank manager in partnership of making that business generate the profit required.
I think these sort of questions are where farming differs from perhaps being a widget manufacturer in Bradford, where you'd expect to leave your business to the next generation having taken out a pension of some description, or generated enough to make a pension of some description to see you into the golf course for your latter years. Farming is a very emotional thing, and when you've got family members involved in it, there's always going to be that bit of nervousness and trepidation about cutting off dad's income when he steps aside, whether he stepped aside from a family business that's been there for 6, 5, 4, 3, 2, 10 generations, or whether he's been there and he was the founder of it. So I think it's a very difficult thing, and it's a very personal decision as to whether a family member becomes a liability or has been such an asset that he's due something from that business. It depends on how that's been left, doesn't it?
Yeah, I think you're right. It should be the family's decision what they want to do. It's not for the bank manager to decide. The bank manager will help support your decision if the business can afford it. And I think this is one of the reasons why all the UK banks have their specialist farming departments, because they do recognise that farming is a little bit different. If you're a widget manufacturer on the outskirts of Stoneleigh, if you have 6 bad months, the shutters will be up and you'll be gone. With farming, if you have 6 bad years, you'll be coming back for a 7th. Because that's the sort of business it is, and that's what banks do understand, and that's why you need that the figures to support that long-term approach that a farming business has to take.
It's an unusual thing, isn't it? Because farming is seen as a sort of a golden boy from a banking perspective, and has been for a long time, and quite a safe bet. However, if any farmer that I know went on to Dragon's Den and had a bit of a go, the widget manufacturer in Bradford might do better, because from a farming point of view, none of it dresses up to make a very good business model when you say it out loud, when the weather is so dependent on what you do, or affects what you do so much. It's such an unusual anomaly in banking. I would have thought a farming business based on asset, even though the bankers will say it's not based on asset, surely there must be some relevance to it behind the scenes.
Yeah, I mean, at the end of the day, those assets behind the business mean the bank manager could always provided he's got a charge over those assets, could get out of jail. At the end of the day, as you'll all be aware, banks have, we've come through a whole period of change in the banking world, and less so, it's almost out of sort of off history now that the banks were just pawnbroker against assets. As I said before, it's very much more a business orientated decision. And to be fair, I think farming is moving with the times as well. I think many farmers now are more agribusiness men, as much if not more than they are farmers, and they're taking a much more if you like, banker orientated approach to running their business, and perhaps they have done in the past, and with less of an expectation and a right to farm, but more a realization that it's a progressive business to manage and move forward. Again, it's up to you in being prepared and in that meeting to convey that sort of more progressive attitude and perspective going forward.
And that goes back, sorry to go back to it, but that goes back to our earlier slide talking about the farmers' objectives and the farmers' wants from farming, doesn't it? There are farmers that want to be agribusinesses. There are also farmers who are quite happy doing what they do and being grateful for the view and where they live, and there's a lot to be said for that as well. So I don't think the bank manager is coming to several different businesses. He could go to 3 different businesses and 3 different farms and come out with 3 different appraisals on that farm, because it depends on what the farmer wants, doesn't it? It's such a subjective thing, and it's difficult to convey that in a presentation like we're doing tonight, is that it is so subjective to different people's personalities.
Yes, we're trying to convey in an hour tonight what a bank manager farmer partnership will have built some years under understanding.
Yeah.
I've got another quick question before you move on to tax, and I don't think it'll take too long to answer. But in terms of proving the business competence, your business competency to a bank manager, is it beneficial to be a partner of the business before succeeding the previous generation?
I think that's a very individual thing. Sometimes it's not a prerequisite. It's not necessarily a benefit, but it could be. I mean, there's many a farmer's son that's been very involved with the business, been very involved with the bank manager meetings, the decision making, the investments decision making, and so on and so forth, without actually technically being a partner on the business. I guess ultimately, if the bank manager is being asked to look at a lending proposition with perhaps a 20 or 30-year repayment process, and dad is on the accounts and dad's 65, then the bank manager will be starting to look at the succession policy in that business. And if the succession policy is, inverted commas, sorted, so albeit with the son or daughter in the partnership and starting to take over the reins, that is an important consideration in that situation.
Yeah, long-term lending is all about succession and planning, isn't it, really? And you could, regarding that question, anyone could be very involved in the business from the age of 16 when they left school, 17, 18 when they left school, to someone that might have gone away to the city to gain some experience in the city doing something, earning a lot of money, coming back in later life to enjoy the lifestyle that farming affords you, or the perceived lifestyle and the vista that farming affords you. Everyone aspires to live in the countryside, but it's an expensive place to live. So it depends on where you're coming from as to how you answer that question. It's a very personal decision, I think.
I talked before about having sort of relevant people in the bank meeting, and definite tick in the box if farmer, even if he's 45, has got his 16 or 17-year-old son or daughter say, well, the bank manager's coming, you better find out what this is like, come and sit in on the meeting. What great experience for the youngster, and to start to get them used to see how it ticks, gives the bank manager a feeling of, well, this chap's starting to understand the succession, starting to sort of realise the longer, bigger picture.
Yeah, and the longer that someone's been involved in those meetings, the more relevant they'll become to the business, I'd have thought, rather than coming as a startled hare into it later on. I think it's very important to include the next generation in these things, because it's not a secret, and it is a family business, isn't it, after all?
Great management exercise, Martin, for the youngsters. If you don't want to fill in the farmer's statement, to set that as an exercise for the younger generation, and one surefire way of them getting to learn about the business. If they start totaling up all the assets and all the liabilities of the business, it will start to give them a feel of what's involved.
Yeah, realise why they're on digestive biscuits and not on hobnobs, I expect.
Martin, we took time's pressing on. We talked a little bit about machinery replacement policy. This is a discussion that comes up from time to time, dare I say it, between farmer and bank manager, and the accountant has his say. You made a healthy, handsome profit, and you'd like to go shopping. Is that your experience?
Indeed. It's a farmer's dream is to own a shiny tractor. Unfortunately, when I left school and left college, a tractor cost about 15-20 grand, and now they're about 150 grand. So the sums have changed a little bit, aren't they, from where they were?
I can understand the challenges here. None of us particularly like paying tax. However, I don't think the tax tail should wag the dog, whether it's on an individual basis or a business basis. If you, at the end of the day, tax, if you're going to buy a kit, or it's only tax deferment to make use of capital allowances. At some stage or another, the business will have to pay that tax. And if it's part of a long-term strategy, long-term cash management strategy, and it's right for the business to spend its profit on machinery, and it's required machinery and not toys, as I put it here, so be it. But explain that story to the bank, and why indeed the bank manager might have to fund some of that machinery expenditure, because because at the end of the day, the year in which the expenditure comes up might be a different year to which the tax profit was generated, so the two aren't always in sync. But like I say, the tax tail shouldn't wag the dog. I like seeing it. I used to like seeing a business paying tax. If a business is paying tax, it must be making profit. If it isn't paying tax, it's either fiddling the tax man or it's not making any profit. And neither of those are particularly to be recommended. So it is a happy balance, but certainly a discussion to be had. And again, coming back to this understanding, this partnership, this communication.
Yeah, well, the tax allowance, they keep changing the tax allowances and making us tempt us into buying things if they possibly can, capital allowances. And yes, it is tempting when machinery is going up at the rate that it is to think, well, if I invest now, it's going to be 10% cheaper than it will be next year. So it's a difficult conundrum. If you leave it for 2 years and it's depreciated by 20% and it's gone up by 20%, it's looking a fairly horrible hole. But I agree with the principle of what you're saying, because you told me off already about it.
So Martin, moving on, how are you on budgets and cash flows?
My budgets and cash flows are okay at the moment. I'll admit that back last November, our office computer exploded on itself, which upset the balance a little bit and put us on the back foot for a couple of months. But I've been doing some budgets and cash flows just lately. My thing about budgets and cash flows is they're such a fluid thing. You can say what you think is going to happen, but going back to Dragon's Den, how did we know the other day we were going to have hail on the rape in flower? How have we known that we're going to have such wet weather in March and April that has hampered planting and hampered putting stock out and hampered price of fodder, price of straw has gone on forever, paying extortionate fees. So it's a difficult thing with the cash flow. It's almost like a dream looking forward, but it's a very fluid statement. That's where I think.
Yeah, and I think any bank manager, any agricultural bank manager worth his salt would understand that absolutely totally what you say. But at the end of the day, and you do them, which is really good. And I talked about farm businesses becoming a bit more sort of business orientated. Budgets and cash flows are a real fodder for a bank manager. But it's not just about producing them; it's using them. And I put just 1 or 2 points there about some key elements to it, and you alluded to some of them already, Martin. They do demonstrate an understanding you have of your business. How have you prepared the figures? On what basis have you prepared the figures? And are you aware of what are some of the key performance indicators in your figures? And yes, you could say, well, weather is the key performance indicator for my business, and I know you haven't got any control over that. So you then move on to sort of the final point there about sensitivity analysis. Well, yes, we all know you can get a hailstorm before your rape's due to be harvested, but how much can your budget withstand? So if you've done your budgets at 5 tonne a hectare and it works, I'm perhaps going to be a bit more on rape. I might be a bit more nervous because I know that might be at the top end of expectations. Whereas if you budgeted 3 and you can show me your 5-year rolling average is 4, that's obviously going to put me in a lot more comfortable position and show me your business can withstand some degree of pressure from its norm, and still me, the bank manager, be comfortable that my interest is going to get paid, that my loan repayments are going to be serviced. So it's all about what you're going to do with those figures and how you're going to communicate that with the bank manager.
Yeah, well, as a cereal farmer, I've got several factors that I don't really know until the day. The yield and price are 2 of them, yield anyway, which are quite massive indicators. If you ask me what I'm paying for chemicals, I probably wouldn't know until I get to the end of the season, because we don't know what we've done until the end of the season. We don't know what it's cost until the end of the season. It's such a fluid thing, and that's what I find hard about producing a cash flow. You can give it your best guess, and I think that's probably as good as you can do with it, really, isn't it? Unless you're going to do 2 lots of cash flows, worst case scenario and best case scenario, and prod a pin in between.
Well, I think as long as you picked out the key performance areas for your business, which, as you say, yield, and you can show what impact plus or minus 20 or 30% or whatever is on that figure, and the impact on the bottom line, that's the key area in this slide.
Yeah.
And I guess I'm able to here just put a plug in for Farm Bench, which is AHDB's cost of production model and management tool. to give you an understanding of what your costs of production are, where the cost elements are in your cost structure, variable costs and fixed costs, and from those you can show the bank manager, how robust, if your cost of production totals £110 a tonne for wheat, and your rolling average is 100, market price is £140 a tonne. There's a bit of slack there.
Yeah, well, I think that's quite right, and also on beef and sheep as well. If you've got beef cattle, if you are budgeting for it, then at least you know roughly where you're going to be, don't you? Unfortunately for the beef and sheep people this time, if they've been buying in straw and buying in silage, this year has been a very costly one for them. I can only sympathise with them, really. Farm bench also is going back to our tax or toys. If we're buying toys and it's adding to your costs, it's going to show up in that farm bench. So yeah, going back to that, maybe we are better off paying tax.
But the great thing is understanding that and being able to show the bank manager, that's communicating it, so he knows that you're on top of your business and the impact of your decisions.
Yeah.
So I guess we're nearly rounding up now, and I've just put in here a slide at the end, which we really started is, we talked about this is all about partnership, it's all about communication, but a lot of what we talked about, you, Martin, can prepare in advance of the meeting on your own or with your advisors, with your family, to really build the evidence up to support what you want out of your business, to support what you want to do going forward, and some of the objectives you set out to achieve. So you're trying to persuade the bank manager or make him feel more comfortable, shall I say, that you have got a strong business. It can take some knocks. It can do everything that your bank manager wants it to do: repay debt, service the debt, the interest and the repayments, and ultimately that he is going to get his money back and not get the sack for having bad debts on his lending book. So with that, I think you can really set yourself up for a successful meeting and predict some of the elements that he's going to be looking for from you, and you can be ready for him to set yourself up for a successful bank meeting.
Yeah, I agree. I think honesty is the best policy. I sat down with my bank manager a couple of weeks ago, and like it or lump it, honesty is the only way forward, I think, with them, and they are your partners after all.
Yeah, that's a very good point. The last thing a banker likes are surprises. So be honest at the outset, and then if things do change, get on that phone and start talking about it. Ultimately, as I said before, the bank manager needs you as much as he needs you, the other way around. And so he'll try and find a way of working around problems if he knows about them in advance, and he can work out them together with you. How's the question, Kerry?
Excellent. Yeah, I've held some back for the Q&A session. Right, so the first one is regarding consultancy. What's your view, Philip, on using consultants as advisors on the farm? Is that a bad reflection on the farmer, or do you think that can be working in their favour, or how would you advise?
I think on balance, it acts in favour of the farmer. The only thing, because it shows that the farmer has got another pair of eyes looking at the business, helping him run the business. I think the word of caution would be that he's not just delegating the whole show to the consultant, because it's the consultant that knows everything and is making it tick, and the farmer is just twiddling his thumbs and carrying on how he has done for the last X years. Because at the end of the day, it's the farmer that's got to live on the farm, if it's the farmer's assets, the consultant can disappear.
I think the consultancy job is a good thing. I think we're all using them in different ways and different guises. They're not all dressed up as consultants. If you're a milk producer, you're talking with your buyer group. If you're a cereals man, you're talking with your agronomist. They're all consultants. If you're a beef man, you go to market and you consult with the people in the market on a Monday or Tuesday or Wednesday when you're selling. So consultants are almost like a ploughing match judge. They'll go around and they'll see everybody's farms from different perspectives, but they see it all. A farmer stuck at home on his own only sees his farm and can become very insular possibly. And so the use of a consultant is another pair of eyes that's actually seen outside the farm to see what could be improved if possible. So if I was a bank manager, I think consultancy wouldn't be a bad thing.
It would tick a box.
Yeah.
Great, thanks guys. Another question from the floor. Would the capital accounts take into consideration the liability of other members of the family? You are still using their assets to generate a profit.
That could be a whole hour on
Yeah.
again. It depends on the basis in which the liabilities of the individual are taken out, and also how how that person is tied into the business by a partnership agreement, or if he's a director of the business, what the company mandate says.
Yeah.
I mean, generally, you know, we talk about joint and several liability. So if a partner's in a business, he's joint and several liability for all the debt.
It's more about business structure than it is about borrowing.
I mean, that is something. I mean, we talk about using consultants. The accountant is a key sort of partner in the business almost, because he needs to understand the family objectives that we've talked about, the long-term game plan, and so that everybody's working together to make sure that the partnership is the company's structure right going forward.
Yeah, and not that I'm advocating any sort of fiddling around, but tax issues might be involved in that as well going forward. So if you've got tax issues, then you're addressing those through partnership agreements, then who can say what might go on? But that's down to a personal choice, isn't it?
Exactly. Another question here. Should you monitor projected cash flow with actual cash flow? Does this actually help with anything, do you think?
I mean, at the end of the day, if it rains and all your figures go upside down, what is. I think the critical thing is to know what has happened compared to what your budgeting was going to happen, and therefore what the impact is going down the line, and whether you're going to need extra funding to cover what's happened, whether that's a short-term blip or whether it's a long-term blip, and depending on which it is, how that support is going to be structured from the bank. All about knowledge of what's going on and communication.
Fantastic. Right, I said we'd finish at 8 o'clock, and we're running close to 10 minutes over. Philip, Martin, I think you really kind of hit the nail on the head tonight. We've had some good discussion, some good tips, and good advice. Thank you very much. Just start looking at the question board here. I'm already having a flood of gratitude and thanks and congratulations on your efforts tonight. It's not just turning up and putting the slides together. We've been doing a bit of work, kind of trying to get it pitched right tonight. Thank you very much. I will be sending out a survey to everybody who attended tonight. Really appreciate your feedback. It's only a short thing, especially in the comments section for any future webinars. It's your levy. I'm happy to put on webinars for whatever would be of interest. Please don't be afraid to feedback. In the next couple of days, the recording of tonight will be put onto our YouTube site. I'll also send a link of that to all of you that attended, so you can have a look through the slides again if that helps you. Anyway, thank you very much. Without further ado, I'll close tonight's webinar and wish you all a good evening. Thank you very much, gentlemen, and good night.
Thank you. Good night.